We have a pleasure and privilege of having two fantastic individuals. I'm going to introduce them to the stage. Yelena, since you're first, it's Chairman Emeritus Yelena McWilliams. Welcome to the stage. I know where you want.
I'm going to be in the middle because Brian is always on the edge.
Brian is always on the edge. Good. Next, we're going to introduce Brian Brooks, a very known crypto individual. Also, we're super lucky for many reasons, but it's a pleasure to have you both today. And first thing we're going to start off with is they actually have interesting paths, these two. But the first one is that they're both recovering regulators. So the question I'm going to have for you, Yelena, do you feel like you've recovered from your regulation days or not? And then the question is going to go to you, Brian, as well.
I think we're supposed to share a mic. This could be interesting. Oh, you got your own? I'm not sharing a mic with you. I will say this, if you're going to charge me for that answer, I have recovered. If you never recover from being a regulator, let me put it that way.
I don't even know if works. Maybe I'll borrow someone's. We have 4, so that. Okay, I do have a mic drop line, but it's later, so that was not it.
No worries.
Anyway, my point is I came to being a regulator a little bit later than Yelena did, but for those of you who remember any of our exploits...
Late bloomer.
Yeah, exactly. But for those of you who remember any of our exploits at Coinbase, my basic view is all of you are regulators in the sense that you're in a highly white space kind of a world, and if you don't give yourself rules, other people will. So in that sense, I hope none of us are recovering regulators. We need to have that responsibility in mind every day.
Fantastic. A little bit of background on both Chairman Emeritus Yelena. She actually told me it was the first time that she had heard that term, but I think it's the appropriate
No, I heard the term. Nobody has ever. That makes me like even older than I.
Okay. Then just managing partner at Cravath from Washington, D.C. Maybe that's a little bit better.
But that makes me a little bit boring. Then.
A little boring. All right.
Can you help me out? Just.
Yep. So Chief Legal Officer at Fifth Third Bank. Does that help?
No.
Back in the day. Oh, all right. Well.
I dance salsa. Okay, can we go?
Yes.
Go with something cool.
Dance also. Yelena actually comes from Serbia. Immigrated to the U.S. Fairly young. Storied career, worked both in the banking committees. She was also senior counsel at the Fed. And has done public and private sector. And anything else, I guess that's interesting to tell the crowd, Yelena?
I'm a good cook.
She is actually a pretty good cook.
I'm a good cook.
Yeah,
Thank you,
not going to lie.
Brian Brooks was the acting comptroller of the currency. He's an entrepreneur. He's a crypto wonk, a nerd. He's currently CEO of Bitfury. He also has interesting background, legal background, similar to Yelena. He was the chief legal officer at Coinbase. Also did some fun entrepreneurial stints. He's an advisor. He's a classical pianist player. And actually has a lot of European roots. In the back room we were talking, and we could tell that he knows about philosophy, and of course is a trained lawyer. But Brian, anything that we need to add, kind of your background here?
Well, the thing you need to add is most people think of lawyers as people who are afraid of risk, but I am sometimes the lead singer in a rock cover band, and you have to have a certain risk tolerance both to do that and to listen to that. So I think my risk tolerance is probably my best quality.
I love that. All right. So maybe let's get started. We're talking about crypto regulation here. And I thought I'd start with kind of a softball question for both of you. You were both bank regulators, but who was the better regulator?
I was.
Brian?
I mean, I don't want to give a long answer or anything, but if you think about it, the FDIC is not really, they're sort of like what we call in banking a backup regulator. Yes.
Somebody mute his mic. Can you help me out? Mute his mic.
I don't know how much you all know about the structure of financial regulation in the U.S. I was just talking to my new friend, an MP from the British House of Commons, where they have sensible financial regulation. They have one regulator for the financial system. It's the FSA, and they're the regulator. Here, we sort of divide regulation up into these three parts, like it's a Harry Potter Horcrux or some nonsense like that. And I think Jelena did a great job of pushing into my area of bank supervision. She really did a nice job.
So the backup supervision is basically keeping checks and balances on people like Brian. So that's really how the system works.
But imagine if I was unleashed. Imagine how amazing that would be.
I don't have to imagine that.
All right, so let's move on.
Do you sell this as a comedy show or no?
No, we're going to get serious now.
Okay.
We're going to get serious. So, setting the stage here, we live in an always-on economy. However, but for fintechs, the experience from merchants, the experience from consumers, and even the market, it currently operates within the constraints of bank holidays and settlement finality times that can take 3, 4, 5 business days. So where do we go from here? We heard Kevin O'Leary this morning talk about regulation that could unleash the space, the digital asset space. We heard from Vitalik talking about regulation as well. Where do we see current crypto regulation with having a couple bills done in Washington, D.C.? If you talk to an optimist, they say it's going to happen. You talk to a pessimist, they say it's not going to happen. Would love kind of your view into the current crypto regulation, where you think it is going to go and what it can do for the industry.
No, absolutely. And I will say this, so I departed the FDIC in February of this year, so some of the memories are still recent, but there has been a lot of development in this space in Washington, D.C. since then. 3 or 4 bills have been introduced with, I think, generally good intentions. And in some cases, not necessarily full understanding of how the market functions and where some of the crypto capabilities are and how they should be handled from a regulatory perspective. The biggest thing I think for folks in the room to understand and to accept is that regulators exist to minimize risk in the system, right? So anything that doesn't look like the thing they know. So if it's not a square peg in a square hole, they struggle. We struggled. We struggled when, well, some of us struggled more than others. Figuring out how to deal with this under our existing authorities. And so, I always say that people in the Fintech, DeFi, crypto space are on the cutting edge of technology. They're inventing new protocols and new technological developments on a daily, sometimes hourly basis. And in Washington, D.C., we're dealing with laws that are put in place, in the case of the OCC, 1865, the National Bank Act, in the case of the Fed, 1913, with some updates, and in the case of the FDIC, 1933. Even the Securities and Exchange Commission, when you talk about is something a security, we're talking about the laws that passed and became enacted in 1933 and 1934. So understanding that regulators need both education and then also the comfort level to understand how to minimize risk in the system, and this is where technologists can really help regulators understand. So I'm hopeful. I'm neither an optimist nor a pessimist. I'm a realist. So I will not say it will pass, it will not pass. I will say what will pass. So.
Yeah, well, let me. I'll take a slightly different take on your question. So, Julian, you started by talking about the always-on economy, and then you asked, what are the prospects for crypto legislation and regulatory reform, this year? If all of the pending proposed regulations and legislation were enacted this year, it wouldn't do anything about the premise of your question, the issue of the always-on economy. Because what we have in the United States, I believe, is a structural problem with regulation, and it is something that really does separate us from the other, G20 nations. I mentioned a second ago the way that we distribute our financial regulatory power across not actually 3 agencies, but 5 agencies, if you include the securities and commodities regulators. The ultimate problem, I believe, that we have, which is the problem that crypto and Circle in particular is trying to solve, is the fact that the nature of the American banking system, which is a closed system, not an open banking system, means that we require anybody who wants to settle a trade, anybody who wants to process a payment to connect through the government's payment system. That is the only payment system we have in the United States. And the only people who are allowed to connect to the Federal Reserve's payment system are banks, nobody else. And so FinTech can't solve that because of the nature of our regulatory system. So you think about all these massive FinTechs that are in the payments business, PayPal, Stripe, Square, others. I refuse the block thing, that's just too confusing. Those companies can't help you process a payment overnight those companies all rely on Wells Fargo or some other bank partner to connect to the Federal Reserve to settle those payments. And so let's be clear, we do not have a fintech payment system because we are operating a government payment system in which only banks can participate. The promise of blockchain is for the first time the promise of a settlement system that is away from the government payment system. So if only you're willing to accept a token versus a dollar, you can now settle trades at midnight on a Sunday night. That's what USDC is supposed to be. And I was there at the conception of USDC in 2018. So believe me, this was a dream that I shared with a small handful of other people. But as long as the banking system is the only, group that can connect to the government's payment system, we will never have always-on economy. That's why crypto must succeed.
Thank you, Brian. Yelena, did you want to answer? Or? You seemed like you were about to say something, so go.
I think that it's important to Brian's point that everything is centralized to the government. The opportunities of crypto and fintech and DeFi are in getting our monetary system, basically not our financial regulation. It goes above and beyond that, which is why you have seen very slow movement in DC. It decentralizing the very premise of what Brian is discussing, the finance, the monetary policy in the United States, and who controls the system. And so, if you go back to my observation, which is not only my observation, I think it's broadly shared, that regulators are generally risk averse, and you alluded to that, Brian. It is not a surprise that it's going to take a while to come up with something in terms of legislation. And I will even argue that in many cases, as Brian had exhibited when he was at the OCC, you can do quite a bit under the existing regulations, even though they're outdated and old. But there has to be a will to admit a little bit of the risk in the system, be okay with decentralized finance, allow for these protocols to happen in either real time or close to real time, and then somehow be comfortable with managing risk in the system in a way that allows the system to function.
Yeah. I think, Julian, if I just the last coda, I think that's a great point. The last coda, though, is none of the bills pending in Congress will address this root issue. They'll designate one agency as the designator of, Bitcoin versus security tokens and everything else. But the root issue we're all working on is not that. The root issue we're all working on is an open financial system as opposed to a government-dominated financial system. And nothing about these bills, even if they all pass tomorrow, will address the issue of open banking, of real-time settlements. None of that's even going to be addressed.
So access to modern financial systems and markets should be a birthright. And yet, we deal with 1.5 billion individuals that are unbanked. About the same amount are underbanked. In the US, a fortress nation like the US has FDIC data from a few years ago, almost a quarter of Americans that are unbanked or underbanked. Meaning they're underbanked, they may have a bank account, but they leverage alternative financial services like payday loans and rent-a-centers and cash checking places. Do we feel like this crypto industry can solve for the unbanked and underbanked?
Well, I'm happy to just give a quick take on it. I mean, there are a lot of reasons that you have people who don't participate in the banking system, but two of the most important are having a bank account costs money, right? So if you have a small balance, the bank eats away at that balance by charging you fees every day. That's on the deposit side. And on the credit side, it's incredibly expensive for banks to make small loans to people because they have human beings who have to evaluate the credit and credit committees that have to approve and everything, and it's not worth doing that for a $500 loan. So on the one side, it's too expensive for a low and moderate income person to have a bank account in the first place, and on the other hand, even when they do, there's no credit available to them because the amount they want to borrow is too small. Okay, so if you believe those are the two things, or they're maybe the two of the most important things, crypto is in fact supposed to solve those issues. So, you might think of USDC as a low-fee checking account, right? It doesn't cost you anything. You can buy it with no fee on a wide variety of exchanges, and because it's backed by dollars that are audited, it's safe, right? But it doesn't cost you anything to hold $400 in USDC. It does cost you something to hold $400 at JP Morgan. And on the credit side, the promise of DeFi, and I'm going to argue that DeFi has made more than its share of mistakes, and I'm not sure there is a project out there that quite does this yet. But the vision of DeFi is a world where algorithmic allocation of liquidity means that you don't actually need a bank credit officer, that you'll be able to dial up an interest rate you want. The algorithm will crawl through the internet to find people willing to take that trade, and you'll get it for virtually zero transaction costs. And so you don't have the problem of it's too expensive to originate the $500 loan. That's what DeFi is supposed to do, is to break down institutional barriers and access global liquidity. If we solve those two problems, the issue of unbanked won't matter. But we're a ways away from getting there, I'd say.
Yeah. And I would say that from personal experience, so 31 years ago, I landed not too far away from here, from the former Yugoslavia, with $500 and opened up a checking account the next day. And I lived in Stockton, California. No comments. And I remember trying to get a credit card because everybody in the United States had a credit card, and I thought it was like such a cool thing to have a credit card. Plus it allows you liquidity that you otherwise don't have if you have no other resources, no parents, no family to help you out in the United States. And I couldn't get a credit card. I got repeatedly rejected. Had no, I joke I was a perfect ninja. I had, except ninja in this case wasn't cool at all. I had no credit score, income, assets, anything like that, and so
People know what a ninja is? No income, no job, no assets. You know what a ninja is?
Yeah. Okay, well, some of you are probably too young, Brian. We're dating ourselves here.
Sorry.
This is from the subprime crises from mid-2000s, and so trying to get a credit card back then was nearly impossible. It was impossible. I had to get a secured credit card, send, $300 of my $500 to get a secured credit card, and then basically have an opportunity to have a secured card for a year before they would release my deposit, and I would have an unsecured credit card. And so when I had a meeting at the White House about a year and a half ago, I told the President of the United States that, one of my biggest successes in the United States was not actually being the FDIC chairman. You come from nothing and you become FDIC chairman and people think that's like such a success. I'm like, I put on equal pedestal the fact that I went from not being bankable in the United States to having an close to 850 credit score. And so I cracked the credit box, the old credit box, right? Had people like folks in this room existed and those technologies existed 31 years ago, I would not have had to work so hard to get credit. So I do believe that in my own experience as a young immigrant coming to this country with barely any resources, that decentralized finance does provide the opportunity for people to be banked, even people like me who had no other venue at that time. And I do think that, as we talk about kind of the wealth gap in the United States, who participates in the economy, who doesn't, here comes DeFi and the protocols that companies bring to the space, and to Brian's point, the algorithmic analysis of information. And I would even say from a regulator's perspective, there's a way to reduce risk in the system. So if I think this can be a symbiotic union of what's good for the consumer and for the country as a whole is actually good for the regulators, because we will have instant information coming in. And one of the things that people don't always know unless they worked for a bank, it was created through the National Bank Act, but there's something called call report data. And so those of you who actually still use banks and maybe look at banks as investors will look at the call report data. And for large banks, it's about 2,400 data fields that's collected every quarter. And for smaller banks, it's about 1,200 data fields. And then banks will submit at the end of the quarter. They have an extra month, so they will submit this data to the FDIC. They will spend another month analyzing the data and then making it available to the public to see the health of the banking industry. And when you think about it, by the time the data comes to us, the regulators, or them, the regulators, I have an alter ego. Apparently, it still lives in my head. Thank you. That data is, in some cases, 4 months old. And by the time we release the data to the public, it's 5 months old. So talk about systemic risk and the inability to see what was risky versus something akin to a Bloomberg terminal, where the data is instantaneously or close to instantaneously given to regulators. You get your cup of coffee, you click, and you say, my little bank in Iowa doesn't look like other little banks in Iowa. Why? Because I have instant data. And I think that's what some of the decentralized protocols are allowing, or should allow regulators. And if regulators are open to seeing the benefits there, I think we can come to a better system.
Absolutely. And the discussion between Main Street and Wall Street, I'm a big believer of relationship banking. So in the 90s, we had approximately 15,000 regional banks. We're down to 6,000, plus credit unions, of course. Where do you see the opportunity there for fintechs? Most regional banks don't have the investment capital to be able to build out an infrastructure that's digitally native. Is there an opportunity there for fintechs to maybe partner with regional banks or maybe infuse some capital into regional banks and grow that ecosystem out?
Okay, can I just say, I mean, this is something that Yellen and I worked on together a lot in government, was to make it easier for banks and fintechs to partner. And it was a weirdly politically controversial thing to do, which is worth talking about for a minute. But, my theory always was that technology should make the concept of the money center less relevant, right? So the reason that in America there really are, depending on how you count, there are really only 5, 6, or 7 banks, and everybody else is a client of one of those banks. And it's because, sort of as Willie Sutton said, you rob banks because that's where the money is. Well, the original model of banking, this is an analogy that a lot of crypto people always enjoy. The original model of banking was very much like the original model of the post office. You know how like the only efficient way to send a letter when you had to send pieces of paper was you had to aggregate them all in one place, and then you could sort them by zip code and then farm them out to their locations. But there was no way for me to send a letter directly to Yelena. It had to go to the central post office and then get bundled with everything else going in that same direction. It was the same thing with banks. It was the most efficient way to allocate capital, to aggregate as many dollars as possible in one place. And then a central credit committee could decide what's the highest value use of all of those dollars. That was the original concept. And so community banks, even regional banks, but certainly community banks, they had no ability to do that. They did not have enough dollars to be relevant. And so basically they were like clients of the big banks, distributing the big banks' secondary products in a way. The concept of fintech, I always thought, was to sort of solve some of that issue. So fintech, among other things, can help small banks find customers where they don't have branches, right? Or they can distribute credit to holders that aren't limited by the size of the small bank's balance sheet, things like that. And so all of that is very promising. What Yellen and I worked on, and I'll let her give her perspective on this, but we worked on 2 rules when we were in government. One was called the valid when made rule, and the other was called the true lender rule. And the concept of these rules was to make it so that if a bank decides to market its products through a fintech, take an example, a lot of banks are behind these big marketplace lenders like SoFi before it was a bank, It used a small bank called WebBank to originate its loans, and then SoFi would buy those loans. What our rules were supposed to do is say that, look, the rules that governed the loan when the bank made the loan will persist even after the bank sells the loan to SoFi. So like if the bank had an interest rate power to charge interest at 6%, in a state where the limit was otherwise 5%, but banks have special powers, then the 6% rate was still legal when the bank sold that loan to SoFi or whatever. That was the concept. Let's promote certainty. Let's let banks extend their balance sheet through these partnerships, is what we said. And some people said, well, gee, that's not a good thing because actually we want lower interest rates. Perhaps not understanding that when you have lower interest rates, you have less credit, right? So people are less willing to lend at a lower rate of return than they are at a higher rate of return. That shouldn't be surprising. And so we tried to create clarity by saying, no, the banks have the power to originate loans at this rate and the power to sell loans at that same rate without it being impeded. Congress got up in arms about that. And while they did not overrule one of those rules, they did overrule the corollary rule, showing that finance is still enormously controversial. And I would just bring it back to, and this is a longer answer than probably, Julian, you were asking for, but I'd bring it back to, you may sometimes wonder, why is crypto so controversial? Why do so many people hate it? Why does Senator Warren give talks about the shadowy super coders who are fleecing Americans and this and that? It's because money has always been controversial. And what we're doing here is we're creating a new system of money, and that is always going to be culturally controversial. You have to have the courage of what you're building here. Money is the foundation on which we all generate wealth. People who started out like Yelena and I did, neither of us started out rich, neither of us started out with resources. But the fact we had an open financial system to some extent allowed us to be where we are today. That is controversial. And yet that's the good that all of you are doing every day. So that's what we got to keep in mind. I'll stop filibustering, Yelena.
Was that the mic drop?
That was, well, I guess I already
Thank you.
dropped
All
the
right,
mic.
that was the mic drop, ladies and gentlemen. This is Converge. But this is where Brian Brooks and I diverged slightly because he said only 5 banks matter, and that's because he regulated.
I said 7. I said 7.
Well, he regulated
Maybe
the 7 largest banks in the United States. My little banks, the other 5,000, actually matter.
Which
no
collectively
comparison
have
here,
the
of
assets
course.
of like one of mine.
I could make so many comments there. And so those
Mine were the deposit insurance fund's biggest customers, though, that's for sure.
And so why that matters is because both of our agencies, 2 agencies, were self-funded, and the FDIC was funded basically on the deposit assessments that we charge for insurance. So whenever you think, the FDIC is spending taxpayers' dollars, no, we didn't. That was those other agencies. We actually produced money and made the system, still make the system safer. But I will say this, the 5,000 banks in the United States who are much, much, much smaller than Brian's 7 large banks, they can't simply survive, to tell you the truth, about the efficiencies, the economies of scale, the customer base. We are seeing rural depopulation in the United States. People want a cool app. They want the coolest app. The little banks can't have an app. In fact, they struggle to have online presence without glitches. And so I think it's paramount, going to your question, for fintechs and technology providers to have symbiotic relationships with these banks. And I think, this is something that, Brian and I focused on heavily when we had the purge of regulatory seats in Washington, D.C. We struggled to actually explain to other regulators why this is, frankly, for the stability of the system. Unless you want the concentration of everything in those 7 banks, or 5, or whatever the number may be, you need to actually be concerned as a matter of systemic risk and financial stability about the health of these little banks. And in order for them to survive and be healthy, they do need to import the technology, import the digital presence, because they don't have the resources to develop it internally. So I would say it's paramount that banks are able to have responsible, safe, and sound partnerships with fintechs that also provide for consumer protection.
Thank you. So I'm going to put you back just 18 months ago, 2 years ago, when you were in your respective roles.
I start twitching when you do that.
And
it was a regulatory joke, people. Come on.
It was. I don't know do we have any bank regulators also sitting here today? I see no hands up. So
They all went to the more interesting panel next door.
So if I walked into your offices and I said, I have a fantastic innovation. Now, this innovation is anonymous. This innovation is expensive to produce. This innovation is expensive to move. It's expensive to protect. And it's expensive to send. This innovation is cash. What would your reaction have been if I came many, many years ago with this cash innovation? And do you see perhaps drawing a line with what crypto is today, which can be synonymous, but can have settlement finality times in the microseconds that can get sent with the superpowers of the internet around the world? And one of the challenges I have is my niece in France, for her birthday and Christmas, when I need to send her money, it's extremely complicated and expensive. And during COVID, I couldn't jump on a plane and actually go have a pleasure of having lunch with her and just giving her a 50 euro bill. What do you think of cash as an innovation versus kind of crypto as an innovation?
Yeah. Brian, go ahead.
Well, I mean, what I think, because I wrote about this pretty extensively when I was in the role. I mean, I think there is a thing that we are losing as a society. We're losing it for some legitimate reasons and for some, I believe, illegitimate reasons. And that is the ability to conduct private transactions, The legitimate reasons that we're losing this ability is because we've discovered that we're now in an era where the world is a lot more dangerous than we thought it was, and so the relevance of terrorism financing laws and money laundering laws is just more salient than it was 50 years ago, I'm sorry to say. But, for those of you who know my views on other monovariate issues, like, for example, COVID, I'm the first guy to say, but there are also other things that are important. It is not only suppressing terrorism financing that is important in a free society. It is also important to allow people to make political contributions without fear of retribution. It's important for people, depending on your point of view, depending on your political ideology. You might think it's important in a small town in the West like I grew up in for people to be able to buy shotguns to engage in their cultural pastime of hunting without having protesters at their house. Or, if you have a different point of view, it might be important to be able to travel out of your home state of Missouri to go to California to procure an abortion, where it's legal. And you may not want your home state people to know about that. There are a lot of reasons why financial privacy is a real thing. And what I think we don't do a great job of in this country is balancing competing goods. You know, it's sort of like, again, I come back to the most recent example we've all lived through. Yes, it's important to suppress the COVID virus. It's also important to have a functioning civil society and a functioning economy. Those are both important things. And it is not possible to have, you know, a life that optimizes for only one of those two things. And so my basic view is, we can't have a world where people can transact millions of dollars in cash with no reporting requirements. We know that now. Because if we did that, people would be financing terrorism left and right, and it would be a scary world. We know that as a fact. On the other hand, you know, there was a proposal in Congress very recently, as you know, that banks would have to start reporting $600 cash deposits, meaning that every single thing you did would be tracked, every cigarette you bought, okay, everything you did that you're embarrassed about, okay, I mean, I don't even want to get into the set of things I can conceive of. I'm not saying I've ever done any of them, okay, but every single one of those becomes known to the government, and that is not the kind of world that probably 99% of us in the room want to live in, and yet, that is the directionality because, again, we're optimizing for only one thing. So my view is, we need a nuanced approach that recognizes the legitimacy of public safety, okay, but also recognizes that the most important thing about the West is we are free societies, and the way free societies are different from other societies is even people who want to make bad choices get to do that. If I want to smoke a cigarette, I get to do that, okay?
I'm not sure I should say anything after this. I'm speechless, Brian. I will say this, that the regulators in DC actually understand the inefficiencies of cash, right? They understand that there has to be a better way of moving money around, which is why, you know, we have ACH networks, again, dating ourselves old-fashioned, et cetera, but it is how the money moves. The money transfers, wire transfers are exceedingly expensive. I remember, you know, wanting to send $50 back to my family in Serbia, and like, you know, certain providers will charge me $30 to send $50, and I was like, well, in what world is this a good, you know, transaction for me? And so I do think that when you look at crypto and you look at blockchain technology, there is so much potential to reduce the efficiencies in the system. You know, speaking of money laundering and all of that, you can actually track stuff in a way you can't track it otherwise. You can eliminate some of the cash economies where, you know, a lot of European countries are actually struggling with cash receipts because they have cash economies and people don't report, you know, their income. And in an economy that everything is on the blockchain and there's a digital ledger for transactions, you actually get to have the tax revenues reflected appropriately. Like there's so many benefits to this, and yet the issue that I have kind of struggled with in Washington is that so many regulators and so many, you know, even legislators, to Brian's point, actually dislike the notion of this technology and being able to do everything on the blockchain. And so I do hope that over time we get to a place where the benefits of the system are able to be what drives the system. And I would say some people will probably find this offensive because they already feel that the system is legitimized, but legitimize the system at the level at which the banking system in the United States, you know, feels ACH, et cetera, and FedNow feel legitimized. And then there are protocols built in place to manage the risk in the system, to allow for anti-money laundering and bank secrecy act reporting to be done appropriately, and then really overall just to allow more people to transmit money and move things around in a way that is actually cost effective.
So, is the U.S. really against innovation? Because I hear that regulators see the inefficiencies of cash. I hear you, Yelena. I also see other economies that have gone completely cashless, like in the Nordics in Europe, for example. Other economies, you're right, if you go to southern Italy and you try to pay for a dish, you better have cash and euros on you, correct? So I actually believe in optionality, that as a consumer, you should be able to pay with the means of payment that you'd like. But what is, putting your US hat on, is US for this type of crypto innovation, or do you feel maybe the US is against this type of crypto innovation?
I think that when you say US, I'm assuming you mean regulators. I think regulators are afraid. Innovation is something, it's not a square peg in a square hole. It's not a round peg in a round hole. How do we deal with it? And nobody, trust me, Brian and I know this, nobody wants to be in a position where, 5 years later, 10 years later, they said, it happened on your watch. And you're like, no, it was my predecessor's watch, or the guy that came after me, or the girl that came after me to run the agency. So everybody's super hesitant to make the move that somehow could undermine the safety and soundness of the system. And I think in that respect, you, Brian, and to some extent I were a little bit unorthodox as regulators because, at least we were open-minded and more proactive about recognizing that allowing some risk into the system, but managing it appropriately and regulating it appropriately actually is better for the system than keeping it all outside of the regulated system. So I will say that regulators are hesitant about innovation. I don't know if they're if they don't want innovation as much as they're afraid of letting something new into the system without knowing how to assess its upside, downside, and everything in between. And at the same time, they need to recognize, frankly, that technology is happening. All of these things are, moving along, and new companies are coming into the system that are able to do things that in the past we couldn't do because of technological disadvantages and the immaturity of the system, but now we can do so much more. And whether it's like water, it will keep flowing, and the regulators can either accept the fact that that's what's happening and then figure out how to manage the system that's already moving, or be so far behind in fighting old battles and old financial crises and old issues with systemic risk that they completely miss this next wave, and then it develops on its own, and then you really don't have any control.
Yeah, so let me give a slightly different perspective, and that is the most powerful thing in the world, is incumbency, right? Status quo. And so if you think about the way the power of incumbency affects views of innovation, on the one hand, you have the incumbent financial services providers, whether they're broker-dealers or banks or asset managers or whatever they are. Banks have a business, traditional banks have a business that is built on a certain set of things being true. It's built on the idea that it's more efficient to aggregate lots of dollars in one place, right? It's built on the assumption that customer relationships are sticky and permanent. I mean, it's built on a set of assumptions. When a technology comes along and says, those things that your business is built on, those actually weren't permanent. Those were just transient features of a pre-technological age, and we can solve those problems and we don't need that anymore. Well, the incumbents get very worried by that. And we have analogies in our lifetime where I think we remember this, right? So if you think about the original internet, and you think about the fact that the original
Brian,
internet...
they're too young.
Yeah, well, I mean, the lights are bright. I thought I saw one person. I think Jim Asperger's out there. He's old enough because I knew him then. Okay. If you think about the original internet, in 1996, the internet came within one vote in Congress of being treated like a telephone company, right? There was a real debate about whether the internet should be regulated like a common carrier, and it almost was that way. And the reason for that is that the common carriers were super worried that long-distance phone calling and all kinds of other things, that whole business model was going to be ruined by the internet. And it was, to all of our benefit. But incumbents have a very powerful ear, and regulators respond to their incumbents. So I can tell you, like in my seat, it makes you feel really special when Jamie Dimon makes the schlep down to sit in your office and talk to you for 2 hours. But that happened to me every month. It was really amazing, like, oh my God. And the normal incentives you have when you're in that seat are the incumbent charter holders of whether they're state banks like Jelena or national banks like me or whatever, is I want these guys to be happy. These guys are my customers. In fact, in a prior era, some bank regulators did refer to banks as their customers. So when you have a technology that is going to destroy or at least disintermediate an incumbent, regulators are going to have, on average, I think we were a little bit different, but on average, it's going to be hard for them to embrace it. So is the US anti-innovation? I mean, no one would say that they're anti-innovation, but they would all be super scared of banks going away or whatever their constituency was. Incumbency is really powerful.
Fantastic. I'm looking at the timer, and we're right on time, and I see Jamise is staring at me. How about we give a round of applause to Jelena and Brian? Thank you so much. That was fantastic.